Yeah, hi, good evening, everyone. So, there is never a good opportunity to invest in fixed income. There is always an allocation which has to go to fixed income. The only change which happens clearly is your returns. Whether it is 5%, 7%, 8%, that's subject to the market, but opportunity always remains. So it's never a thing that there is a nice opportunity to invest in fixed income. One important rule of fixed income is you got to have patience. The investment horizon has to be decided even before we invest the money into any of the fixed income product. So why fixed income is a good opportunity is only because of the kind of return available 2 years back and kind of returns available right now. If you look at this chart, interest rates over last couple of years has been quite volatile. We have seen 10-year GSEC going above 8% also when it was 2013, when there was some crisis of quantitative tightening at that point in time, but most of the time it had been around 7.5, and that's where we are right now. Last 1 year, last one and a half year, we have seen interest rates. I'm just taking this as an example, but interest rates, be it a 3-year paper or be it a 10-year paper, but it has gone up by almost 200 to 150 basis point. So there lies the opportunity. Then why we are saying that it can't go higher? There are two things to it. One is, will it go higher? Another thing is, even if it goes higher, how is it going to impact my returns? So will it go higher? The question is, I don't think so it will go much higher. We are probably at the peak because the things which are happening like inflation and all, which is peaking out, and past hikes are also impacting the inflation stabilizing, not only in India, but in US. So when you look at US, you are looking at a slowing pace of interest rate hike. Similar thing is watched in India also. So over a period of time, somewhere we have clarity that, okay, 2 years down the line, probably or 3 years down the line, we might see interest rates at lower level than where they are right now. And that's why the opportunity. Even if someone invests in a 3-year PSU paper or a GSEC paper, which is available to you around 7.25 or 7.5 levels, after 3 years the paper matures and you get, say, 7.5 kind of returns. Now that's fabulous. You know the rates, the income tax rates or the taxation on 3 years plus mutual fund debt product, and you look at 7.5. So post-tax we can very well calculate, and we can compare it with the ongoing post-tax returns or any bonds which are giving post-tax returns or tax-free returns as of now. So clearly I feel at the level of yield itself is a very attractive level for us to look at fixed income. Now, are we satisfied with 7.5 kind of return looking at other sets of return, or we want 9%, 10%, 11%? Well, more is always better, but 7.5, 8% has been a standard return for a product like, say, a short-term fund or any other product. Normally, you will see last 10 years return or 5 years return hovering around on an average 7.5 to 8%. So we are somewhere there. So from here, even if the interest rates goes up to say 8%, if you hold your investment for a said investment horizon suitable or relevant for that product, I don't think so any of us will get a negative surprise. Now you look at different kind of asset classes, be it SDL, be it GSEC, be it a 3-year bond, be it a 10-year bond, or be it a non-AAA bond. Everywhere, last 2 years at least, the yield has gone up. And we very well know the reason. There have been geopolitical crises because of which inflation went up, because of which a lot of economies started hiking interest rates. Even India did hiking interest rates, and that resulted in overall yields going up by 150, 200 to 250, even in some cases the yields going up by 250 basis points, especially at the shorter end of the curve. And the opportunity, which lies on the fixed income side is not, say, a 1-year paper which is trading at 7.5, okay, in 1 year you get 7.5. A 2-year paper, you even get 7.5 because the entire yield curve is flat. But if you look at slightly longer tenor, if someone has to lock in the return, not take the reinvestment risk. Say, for example, what happens if you invest in a 1.5, 2 years papers today at 7.5 or even 8%. After 2 years, the paper matures, and after 2 years, you invest the same money at 6.5 or 6% if the interest rate comes down. But what if we are getting, or the government is giving us an opportunity to lock in the return, say 5-year return, 6-year return, or even 3-year, 4 years return at 7.5 plus or slightly plus than 7.5. So mutual fund gives you that opportunity that if you're locking into some returns right now, say for example, index-based fund or a ETF fund, which we have seen in vogue recently, there you can lock in the return in a target maturity fund probably, and you have the returns visibility that post 5 years I will get so and so returns, and the taxation is also effective. So it is not only the rate which is important while investing, it is also the tenor which is important while investing, because the reinvestment is the biggest risk. I will not say that mark to market is the biggest risk in fixed income. Mark to market will change only your NAV, but if you are waiting for the desired period which is suitable for that particular product, I don't think so any of us will get a negative surprise to a very large extent. In fact, you can lock in your returns at a good level today for next 5 years and enjoy that return, whereas the market returns might be lower. Still you will get a similar kind of return in many of the products available in the mutual fund arena, as compared to many other products which are giving good yields, but the tenor availability is quite less. The longer you go in that particular instrument, you are getting lower and lower yield. That as compared to mutual fund or the market is very, very different. The market opportunity is for medium to longer tenor, but mutual fund is the right vehicle by which you can match the opportunity available in the market for that particular tenor, because it's a pass-through vehicle ultimately. There is one more thing which I would like to cover is the credit growth. The credit growth in our economy has been rising. In fact, in last 1 year, it has almost more than doubled. It was 7.3 in December 21, and right now it is close to 17%. Why I am suddenly going on to the credit growth? Because it's an opportunity. Whenever there is a credit growth means lot of corporates, SMEs and industries are taking money from banks under credit. That's what is credit growth. Once the rate goes up and the credit is going up, people from loan market shift to debt capital market, and that's where the supply into debt capital market, the liquidity into mutual fund and corporate bond market increases. So credit is a good indicator of future better liquidity into corporate bond markets, and corporate bond market liquidity is suitable for many products. The opportunities are available in many products which probably we are not looking at right now. If you look at one more case, the household saving. Now here I have taken only household saving, not the institutional saving. That's why the percentages are looking small as far as mutual fund is concerned. So when you look at household money, almost 60%, 55 to 60% is going to traditional instruments like FD. If you look at, say, insurance or currency, they occupy the second largest space. And if you look at debt mutual funds, it is hardly 2%, which is very, very low. We all understand debt as a corpus in the industry is quite low as compared to many other asset classes. Why? Because many of us just look at the volatility but don't look at the opportunity or the real risk, which is the reinvestment risk, which comes to us, but it doesn't show us that, okay, volatility can be seen, but reinvestment risk cannot be seen. So this is the potential we have to tap. I'm not saying that we have to go and stand outside a bank and tell all the FD to convert into mutual fund. That's not possible. But this is a very large piece, and in foreign countries and out of India, we have seen this component getting squeezed and mutual fund component getting bigger and bigger. So this is an opportunity for all of us. Many retail investors, they come to you, they discuss strategies with you. We have an opportunity here to convince them to come into, to shift their money from deposits to mutual funds. Similarly, now coming back to what are the opportunities, one is obviously, as I've covered in the past, target maturity fund, which you all might be aware. In last 1.5 years, 2 years, we have launched a lot of passive products like index-based funds, ETF funds. In that, the most popular product is the target maturity fund. The benefit of this fund is basically you have the returns visibility over a period of time. Where you are entering, probably that's the potential what you get. But here, this fund asks for some kind of discipline from the investor side that, okay, if you are comfortable with a 3 years kind of duration, invest into a 3-year target maturity product. Basically, your investment horizon and the duration of a target maturity product, if it matches, or maturity if it matches, then certainly you will never ever get a negative surprises. Secondly, all these products are in basically sovereign, majority of the products are in the sovereign area. So stability or security is also not an issue. Second is one forgotten product, and many of us don't have a very good view about this product. But look at the potential of this product. If you look at this product from a 1-year basis, it's not a good product, even I agree. But if you look at the flows are negative, but if you look at the returns, that for last 2 years, if I would have calculated 3-year return for a person who have entered in last 2 years, then which covers the credit crisis, because the person who has entered in December 22, obviously he would have seen a lot of defaults which happen in our industry. But even after that, his returns are in excess of, say, 8.5, near about 8.5 to 9% over last 2 years. So what I'm saying that corporate availability is an opportunity, gross yield is an opportunity, and that's why credit risk funds are an opportunity. The last of my suggestions will be short maturity fund. This is the beautiful product, the sweetest spot on the yield curve, where if you see that the gross yield of the product or the return from a product was basically YTM of the product was around 5% and the maturity was 2.63. So as per SEBI, you cannot change the maturity below 1 year and above 3 years. So it remains stable between that. So the green line is the stable line which has stayed for last 3 years at least. But look at the YTM, it has gone up from 493 to 763, so almost 250 basis point uptick. And this product is nothing but a function, the returns are a function of a gross yield. So today, if someone is entering at around 7.5 levels with your duration staying around similar levels, I am sure that if he waits for 2 to 3 years period, taking the best of the tax advantage, his return will be equal to where he's entering or the gross yield of the product in any condition. It's a most non-volatile product available in the markets. Secondly, the industry size is also close to 1 lakh crore. So what I want to convey through this is when we are looking at stability, when we are looking at consistency, when we are looking at reliability, we have no one but Rahul Dravid as our icon for these 3 functions, and that's why I think that we have a Rahul Dravid kind of opportunity through fixed income right now. So that's all from my side. Thanks a lot. Thank you very much.